The market for precious metals, specifically gold and silver, has recently experienced a notable pullback. This correction follows an extended period characterized by significant upward price momentum. Such price movements indicate a shift from previous trends, warranting close observation. A detailed examination of the underlying market dynamics is crucial to understand this change. Analyzing these dynamics helps identify the factors contributing to the current price correction. This analysis provides insights into potential future movements and market stability. Gold is traditionally regarded as a safe haven asset, sought during economic uncertainty. Recently, the price of gold has undergone a significant downward adjustment. This decline suggests a notable shift in overall investor sentiment. It may also indicate a reevaluation of current global economic conditions. Silver prices have recently experienced a retreat in value. This trend mirrors the trajectory observed in gold prices. Silver's price movements often exhibit greater volatility compared to gold. The synchronized movements indicate common influencing factors affecting both precious metals. Price action in financial markets does not occur in isolation. It is deeply intertwined with the broader global financial landscape. Various economic indicators are crucial in shaping market dynamics. These indicators signal potential shifts in investor strategies. They also reflect changes in overall investor risk appetite. The strength of the US dollar significantly impacts the pricing of precious metals. Precious metals like gold and silver are predominantly priced in US dollars globally. When the US dollar appreciates, its value increases relative to other currencies. This appreciation makes dollar-denominated precious metals more expensive for non-dollar holders. Consequently, increased costs can lead to reduced demand from international buyers. This reduced demand often exerts downward pressure on the prices of gold and silver. An inverse relationship often exists between the US dollar index and precious metals. A stronger dollar makes dollar-denominated assets more attractive to investors. This includes assets such as US Treasury bonds, which offer competitive returns. Consequently, investment may be diverted away from precious metals like gold and silver. Interest rates are a significant economic driver influencing investment decisions. Real interest rates, specifically, play a crucial role in this dynamic. Higher real interest rates increase the opportunity cost of holding non-yielding assets. This makes assets like gold and silver less attractive compared to interest-bearing investments. Interest rates play a crucial role in determining the attractiveness of various investment vehicles. As bond yields increase, fixed income investments become more appealing to investors. This heightened appeal can prompt a reallocation of capital from other assets. Specifically, investors may shift funds from precious metals to bonds. Such a shift in investment capital can exert downward pressure on precious metal prices. The safe haven paradox describes an unexpected market behavior. During uncertainty, traditional safe haven assets like gold may decline. This occurs when other assets are perceived as more reliable safe havens. Examples include the US dollar or government bonds, preferred by investors. During periods of extreme market stress, investors often seek to convert assets into cash. This phenomenon is known as a dash for cash or a liquidity crunch. Even traditionally safe haven assets, such as precious metals like gold and silver, are sold. Investors liquidate these assets to raise immediate liquidity. The increased supply from these sales can temporarily depress the prices of gold and silver. This counterintuitive price movement highlights the safe haven paradox during liquidity crises. The safe haven paradox describes how investor behavior shifts with perceived risk. A decline in the value of precious metals, like gold, can indicate a market trend. This decline often signals a reduction in perceived systemic risk within the global economy. It also suggests a decrease in overall economic uncertainty among investors. When investors feel more confident about future economic stability, their behavior changes. Consequently, the demand for traditional safe haven assets diminishes. The 2008 financial crisis triggered widespread market instability and investor panic. Initially, gold prices declined as investors liquidated assets to raise immediate cash. This selling pressure was driven by the urgent need for liquidity across financial markets. However, gold soon experienced a significant rebound in value. This recovery was fueled by the implementation of quantitative easing policies by central banks. Fears of future inflation also drove investors to seek gold as a safe haven asset. The early 1980s witnessed a significant decline in gold prices. This decline coincided with a sharp increase in interest rates. The rise in interest rates was a deliberate monetary policy to combat inflation. This period illustrates the direct impact of monetary policy on precious metals like gold. The taper tantrum of 2013 was a significant financial market event. It was triggered by market anticipation of reduced quantitative easing by the Federal Reserve. This expectation led to a sharp sell-off in bond markets. The sell-off was driven by the prospect of higher interest rates. Consequently, gold prices also experienced a decline during this period. Historical instances reveal that market dynamics can influence gold's traditional role. Gold is often considered a safe haven asset during economic uncertainty. However, specific market conditions can override this safe haven appeal. Interest rate movements are a key factor impacting gold's attractiveness. Liquidity needs can also lead to gold being sold, despite its safe haven status. Investors closely monitor inflation expectations as a key economic indicator. Gold often serves as an inflation hedge, preserving purchasing power during rising prices. If inflation is anticipated to be low or declining, gold's appeal as a hedge diminishes. This reduced appeal directly impacts the demand for gold in financial markets. Central bank rhetoric and policy decisions are critical factors for investors. Key policy tools include adjustments to interest rates and quantitative easing or tightening. These decisions directly influence market sentiment and asset valuations. A hawkish stance, indicating tighter monetary policy, typically creates downward pressure. This pressure is often observed in the pricing of precious metals and other commodities. Geopolitical tensions often increase demand for gold, which is considered a safe haven asset. Investors seek gold during instability to protect their wealth from market volatility. Conversely, the absence or resolution of such tensions can reduce this demand. As stability returns, investors may shift to riskier, higher-yield assets. The nature and severity of geopolitical events are continuously monitored by investors. This assessment helps predict gold price movements based on global stability. Strong economic growth figures are key indicators for investors monitoring market conditions. These figures often signal a risk-on environment within financial markets. In a risk-on scenario, investors typically favor growth-oriented assets. This preference shifts capital away from traditional safe haven assets. Consequently, the demand and pricing for assets like gold and silver can be negatively impacted. Industrial demand is a critical factor influencing commodity prices, such as silver. Silver's value is significantly tied to its widespread use in various industrial applications. Economic slowdowns directly impact industrial activity, leading to reduced production. A decrease in industrial output subsequently lowers the overall demand for commodities like silver. This reduced demand can exert downward pressure on commodity prices, affecting investor returns. The VIX index is a key indicator that measures market volatility and investor fear. It quantifies the market's expectation of future volatility, derived from S&P 500 index options. Precious metals, such as gold and silver, are often considered safe haven assets during market uncertainty. Historically, the VIX index exhibits an inverse correlation with the demand for these safe assets. A lower VIX indicates reduced market fear and a more stable economic outlook. This reduced fear typically leads to decreased investor demand for precious metals as safe havens. Recent market pullbacks often indicate significant shifts in investor behavior and capital allocation strategies. Such movements suggest a reallocation of capital away from assets previously considered safe havens. This capital is then directed towards other asset classes, signaling a change in investment priorities. The reallocation reflects an underlying shift in overall market sentiment among investors. It also indicates a reevaluation of risk assessment, influencing future market trends. Precious metals, like gold and silver, are often considered safe haven assets during economic uncertainty. Investors typically turn to these assets to protect their wealth when market conditions are volatile. A sustained decline in the prices of precious metals can signal a shift in investor sentiment. This decline suggests growing confidence in the stability and future growth prospects of the global economy. As confidence rises, the perceived need for protective assets diminishes among investors. Therefore, falling precious metal prices can indicate a more optimistic economic outlook. Market signals can reflect confidence in current monetary policies. These policies aim to effectively manage inflation and stabilize economic conditions. Such confidence reduces the perceived urgency for alternative stores of value. This indicates market belief in the central bank's ability to maintain economic stability. Current price adjustments in gold and silver are complex signals for investors. These adjustments reflect a confluence of various macroeconomic factors. One key factor is the strength of global currencies. Another significant influence is the prevailing interest rates. Global economic sentiment also plays a crucial role in these price movements. Investors must carefully analyze these interplays for future investment decisions.